The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The equity market thinks it's called the bottom, but has crude oil called its top. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Isabel Lee. We're kicking off to the close on this Tuesday in New York. You see the S&P up by 0.3%. Traders are really trying to cautiously assess the market as they assess the impact of the energy oil. You see oil there up by 3%, soaring really up around $103 per barrel. You hear a collective sigh of relief as the oil eases from session highs because traders are really worried about the impact of high energy oil prices on inflation. You have the U.S. 10-year yield down ever so slightly by 1 basis point. We have the Fed meeting concluding tomorrow. We have officials really preparing to stand pat when it comes to the interest rates. And lastly, what's aboard without Bitcoin? Bitcoin, you see, up around $74,000, up by 0.6%. Really, we use this as a risk assessment. And you see here green on the screen, which means traders are bullish. Romaine.
A bit of a rinse and repeat from what we saw yesterday here on day 18 of the war in Iran. And oil market volatility has actually calmed enough to embolden equity traders for a second straight day. In fact, WTI's second month implied volatility down about 16 percentage points since Friday and a third of what it was just a week ago. And while prices are still elevated, as you saw on Isabel's board, they do appear to have found some temporary stability around that $100 a barrel mark for Brent and 95 or so for WTI. And for some folks, that's good enough. In fact, you take that into account, and we had the U.S. Airlines today at a conference talking about, well, nothing really. In fact, they showed little worry about the war and even said that they're actually seeing a surge in bookings as travelers get ahead of potential fare increases. Delta having its biggest one-day gain in a month and a half. Cruise lines, hotels, travel agency stocks, they're also higher. In fact, if the current price action at the index level holds into the close, this is going to be the broadest one-day rally for the S&P so far this year. But there is a caveat.
There's about 120 or so names that are trading in a similar band as what the S&P index is trading in, that kind of 5% up and down band. But almost the same number of stocks have moved by up more than 20% or down more than 20%. So the tails of that distribution are larger than they have been. I think that kind of backdrop is likely to continue.
And adding to some of those calls of caution is that, well, the bulk of the market leadership of late still remains concentrated in energy stocks. Analysts at Jefferies citing massive inflows of U.S. active and passive funds that began before the war and have accelerated since. That's pushing the rolling 12-week total for energy stock holdings to, believe it or not, to 7% of assets under management. So a lot of questions about, well, how all of this actually might end and what the market positioning is telling us. Jimmy Chang joins us to kick us off to the close, Chief Investment Officer at Rockefeller Global Family Office. Jimmy, great to see you here.
Hi.
When we look at the geopolitical tide, I think over the last couple of weeks or so, and the idea that you have a market that seems to be trying to find the bottom or the end, if you will, here, is there anything that gives you confidence that the worst might actually be behind this market?
I think there's just so much uncertainty. And my worry is that the market appears to be too sanguine. Now, investors have learned from last April, don't bet against the president. He can so-called taco at any time. And subsequently, there could be a big relief rally. So people don't want to miss out on the rally. And also, historically, they've learned to look past geopolitical issues. But this time around, it seems the scale, depth of this crisis are greater than what we've experienced in recent years, and so a lot depends on the duration of this, of this conflict and how much energy prices will stay elevated. Mm-hmm. And I found it, it's interesting you talk about massive inflow into energy stocks, and yet you're seeing airline stocks rallying. That's just a natural disconnect there.
Yeah, and there's a lot of disconnects in this market right now in terms of what people are pricing in. And it gets to the idea as to whether you are looking to a potential, economic ripple, major economic ripple. And I'm talking primarily for the U.S. We know there's going to be some overseas in Europe and Asia. But in the U.S., there's this idea here that we are insulated from some of that oil shock. Do you buy that?
Yes, we're somewhat insulated, especially in the near term on aggregate level, because we're getting a lot of tax refunds during the season, February through April, and it's estimated to be about $150 billion more than a year ago. And most of that money will likely get spent. So part of that will offset the rising energy prices. And we're already seeing gasoline prices have spiked up about 80 cents per gallon since the war broke out. So it's kind of mixed, but we do have the benefit of tax cuts and tax refunds.
And you mentioned a double-digit correction in equities potentially. What would trigger that, and would you be buying into the weakness?
Yeah, I think if we do get a double-digit correction, that would be a buying opportunity. Because again, if you look at the calendar, I would suspect the U.S. would like to wrap up the campaign as soon as possible, probably no later than, let's say, end of April. And if that's the case, it's of limited duration. Hopefully, the jump up in energy prices won't be lasting, so there will be a relief rally. But in the interim, it's surprising that since the war broke out, the S&P 500 index is down less than 2%, and that to me is a fairly sanguine market. But in a way, it's good because it allows the president to prosecute the war to the fullest extent. There wouldn't be that pressure on him to kind of stop too early.
It does seem like that. We have investors expecting a quick resolution, but then things are more nuanced. What needs to happen for investors to really have a market repricing?
It's really hard to tell. Right now, it's kind of a test of endurance, the relative threshold of pain amongst the Iranian regime, and here in the U.S., the political, the economic pain. I do think if you look at the timing, the Secretary of War just called the Marines from Japan, and that will take 2 weeks to arrive in the theater. So that takes us to early April, assuming we use the military force to open the strait. That may also take some time. So unless Iran start to collapse internally or to surrender, which I don't anticipate, I think they'll try to tough it out. So this thing can still drag on for at least a few weeks.
Well, when we talk about the potential for this to drag on, then it raises a lot of questions about what other policy responses there might be in terms of maybe trying to bolster the economy. We have a Fed meeting that's going to conclude tomorrow. No change in rates expected, but obviously Jay Powell is going to be asked a lot here about where the Fed sees economic activity going, where they see inflation going. Is there any potential that we maybe could see a situation where the Fed would be inclined to actually raise rates later this year rather than cut them?
It's highly debatable. I think people will look past the next two FOMC meetings. Now, certainly the meeting tomorrow is interesting to look at the guidance, the dot plot. But ultimately, it's going to be Kevin Warsh's Fed. We'll see. I think people will pay more attention to the confirmation hearing and then see how he will implement his programs in his own Fed.
All right, Jimmy, always a great conversation. Jimmy Chang, Chief Investment Officer at Rockefeller Global Family Office, kicking us off to the close here on this Tuesday afternoon. When we come back, we're going to take a broad look at the real estate landscape, particularly when it comes to residential real estate. Amherst CEO Sean Dobson going to be joining us to talk about supply, demand, and the mortgage affordability question.
Plus, data centers, one of the key drivers behind construction volume. We'll discuss the other side of the data center coin, electricity, along with broader energy landscape with the CEO of TC Energy.
And then we're actually going to go back to real estate as well and talk to two of the most recognizable names in the industry, the Property Brothers. I think I got them right? The one on the left is Jonathan, the other one on the right is Drew, or vice versa. All that and more coming up in a bit. This is The Close on Bloomberg.
We're less than 24 hours away from the next Fed decision. The war in Iran complicating the economic landscape. Energy prices spiking, global bond yields rising as investors parse the developments. So bond managers now expecting central banks to diverge on policy as the conflict rages. Joining us live is Brij Khurana, fixed income portfolio manager at Wellington Management. Brij, thank you so much for joining us. So markets seem to be replaying the Russian invasion of Ukraine playbook. What do you think is fundamentally different about today's market, though?
Yeah, I think you're right. That is the playbook the market is anticipating, which is you've seen yields move higher, Europe underperforming because they're more commodity sensitive than we are in the U.S., inflation-linked bonds outperforming and the dollar moving higher as well. So I do think there's a lot of key differences between now and what we saw in 2022, the Russian invasion, in that the labor market in the U.S. is in a fundamentally different place than back then. So back then, we had job growth of at about 500,000 per month. In the last 6 months, we've actually lost jobs in the U.S. Similarly, on the inflation side, core inflation heading into the Russian invasion was close to 6% in the U.S. compared to about 2.5% today. So inflation is not as persistent as it was back then. And most importantly, I think on the consumer side, there were years of aggressive spending Consumer surpluses were about $2 trillion. Most of those balances have been worked through at this point. And so, there is this question, are obviously energy prices moving higher are inflationary in the short term, but they have the potential to be disinflationary in the long term if it causes consumers to retrench and raise their savings rate. Now, that's dependent on if the Fed doesn't ease. It's dependent on whether or not there's more fiscal spending coming. But generally, while it is short-term inflationary, it has the potential to be longer-term disinflationary.
So let's get to the Fed.
Yeah.
With the Fed entering the meeting tomorrow, any signals you're looking for from Jerome Powell or when the press conference comes?
Yeah, so, they're not going to cut rates. The market's pricing virtually no chance of that happening. Right now, for the year, the market's pricing in at about one cut for all of 2026. So the focus is going to be on the 2026 dot and saying, what is the median voter of the Fed? Where does they think it's going to be? I think right now it's actually in line with the what we saw last December. I think given what we've seen in Iran and the makeup of the committee, you could actually see that go back to unchanged, meaning no cuts this year. Now, obviously, we're going to have a new chair in 2 meetings, most likely, assuming Warsh is confirmed, which is very likely. So, that could change the outlook. But as of now, I think there could be a little bit of a hawkish surprise tomorrow if we suddenly see the committee say there's going to be no cuts for 26.
So when we talk about what that means specifically for treasuries, do you anticipate that we will recoup some of the, I guess we could call them losses? Basically we've erased most of the gains for the year. Last time I checked, do you think we can recoup that potentially if the Fed does actually go in the direction most people think it's going to?
Yeah, I think there is still value in long duration bonds because, as I said, even if this is a temporary inflation shock, as long as we don't see more fiscal stimulus as a result, as long as the Fed doesn't ease into it, there is enough term premia or the compensation you get for moving out the yield curve already in bond prices. That being said, I think it is a little bit safer bet to move outside of the U.S. in a lot of different global bond markets. The U.S. is still pricing cuts over the next 2 years. If you go to other markets, they're pricing in a lot of hikes. In Australia and New Zealand are pricing in close to 100 basis points of hikes over the next 2 years.
Right.
And if you actually take out the currency risk, you can earn much higher yields than you can even on U.S. Treasuries. So going global is helpful in this context.
In developed markets, what about in emerging markets, specifically because of the issues now with Iran and energy prices?
Yeah, I think emerging market local bonds is an interesting area. These are bonds denominated in their own currencies. So Mexico issuing in pesos, for example. And this was one of the best sectors in fixed income markets last year. Bonds were up almost 18 to 20%. Now, they have gone through a bit of a drawdown, almost 5% because of the Iran war. That being said, the fundamentals are really strong there. Policy rates are still very high. Inflation's coming down. They're not spending fiscally the same way that we've had, and growth has been relatively slow. So there is still room for those central banks to cut. At the same time, commodity prices in general can help some of these economies, which are more levered to the commodity cycle. So I do think that is a new opportunity, that has been, was attractive last year, but has gone through a temporary repricing.
How exposed is the U.S. to foreign selling if higher energy prices really start pressuring countries like Japan or South Korea? Yeah,
I think that's a very important point because the narrative in the U.S. right now is because we have become energy independent, oil prices are less impactful to the economy. And that is all very true. We have done a lot, and the shale revolution has revolutionized a lot of things. That being said, what has changed in prior episodes is how much more financialization there has taken place in the economy and how much U.S. assets are owned by foreign holdings. So if you look at currently about 28 trillion of U.S. assets are held in foreign hands. If you look at some countries like Japan, like Taiwan, like Korea, oil prices in their own currencies, which have depreciated, are close to the highest they've been in the last 25 years. And so, these countries have not been selling U.S. assets yet, but if these high oil prices do continue for quite some time, at some point they might need to start reducing some U.S. assets in order to fund their oil balances. As I said, it's not something we've seen yet in any of the data, but it is something to think about longer term, that even if the economic impacts to the U.S. are muted, the financial impacts can be more dramatic, and not many people are thinking about that.
All right, Brij, great conversation. Great to have you back. Brij Khurana, fixed income portfolio manager over at Wellington Management, as we continue to count you down to the close. Green across the screen right now for U.S. equities, yields down for a second straight day. When we come back, a refocus on the real estate market, the residential real estate market, with CEO of Amherst, Sean Dobson. That conversation up next. This is Bloomberg. Pending sales of U.S. existing homes they actually unexpectedly rose in February for the first time in 3 months. Buyers, they took advantage of that drop that we saw in mortgage rates, as well as a slowdown in price growth. That is welcome news for the real estate market ahead of the spring selling season. But of course, rates are still potentially volatile given everything that's going around, and still a lot of questions out there about housing affordability. Our next guest is a big investor in this space, leveraging technology to find the best deals for himself and maybe for other folks as well. Sean Dobson joins us right now. He's the CEO over at Amherst. Sean, great to have you here. I do want to start off first with mortgage rates. I mean, we did see briefly a bit of a dip in rates, and that seemed to entice some buyers off of the sidelines potentially. But I am curious that as you sort of look at the rate landscape, do you see a meaningful drop for the rest of the year from where we are right now?
There's certainly room. We focus heavily on the real rate to kind of give us a view of what the overall risk premium is in the capital markets. And we think there's room for real rates to come down. So we think that there's easily 50 basis points to 100 basis points room in long-term mortgage rates as if the fixed income markets become a little less volatile.
We've talked a lot before, Sean, about kind of government policy or the lack thereof in addressing some of the affordability issues, whether it's on the borrowing side or whether it's on the building side and kind of everything in between. Have you actually seen any progress, any material progress of anything potentially coming, not just out of Washington, but even at the state and local level that would alleviate some of these issues?
Well, there's certainly a lot of focus. Affordability polls as the number 1, 2, or 3 item on voters' priority list. And so the voters have their elected officials' attention. There's a lot of ideas floated around. And as you know, we spoke about in the past, some of them we think are horrible ideas. But we got some good news this week out of the White House. The president put out 2 executive orders, one of them directly addressing access to mortgage credit. So it's clearly a step in the right direction. And I would say, finally, I've been talking to you guys about the lack of access to mortgage credit for our customers that we serve in our single family rental business. And it's refreshing to see Washington finally get around to what the real problem was, which is there is no mortgage market for anyone but sort of the top quarter of our wealth in our society.
Sean, will these executive orders on housing affordability actually lower costs for families, and how quickly will we see that?
Well, the ones that we're the most positive on are related to mortgage access, and the ink is still wet on them. They are, I would say, fairly broad, aspirational, calling for studies, calling for research, calling for policy makers to work within their existing confines. So we don't see anything like a repeal of Dodd-Frank or reform of Dodd-Frank, which we think is what's really necessary. So no, I don't think that there's sort of a big affordability magic button that's about to be hit anywhere in Washington. I think this is going to take time, and I think that the solutions that the market has in place are serving the American consumer, and Washington is rightly focused on serving them better. But, Ronald Reagan used to have a great quote about the scariest words in the English language are "I'm from the government that's here to help." And we're starting to see some of that, So we've got the ban on institutional investors, which is a ban on supply of homes for renters. At the same time, we've banned lending to many of the American families that rely on those homes. So we're a little nervous that the government's here to help, and we may suffer the consequences.
Yeah, speaking of that, what happens to housing supply if institutional investors are indeed restricted from buying homes?
I think we'll see no impact on the current demand because institutional investors have not been an impact on demand at all in the last 2 or 3 years when home prices have become so unaffordable. Remember that home prices are up 60% post-COVID. The investors were not the cause of a 60% rise in home prices. That was more of a function of the amount of money that was printed and the excessively low interest rates. So I think we're going to look at this is going to take some real time to dig out of this. But the key is mortgage credit. The families that we serve are not served by today's mortgage markets, and yet they get to live in a 3-bedroom house in a nice neighborhood. So we're on to the right subject, but the conversation just began.
Well, we'll talk a little bit about your business. Obviously, you're fixing up homes, you're renting them out. We actually had a conversation a little bit earlier today that we're going to play with the Property Brothers. They're in the same business as you, maybe not as successful, but certainly more popular.
They say it way better than I do. Remember, you got on to me last time that I wasn't selling my story very well.
But they actually did talk a lot about this in serious and themselves and what they're trying to do as well, particularly in addressing some of the affordability issues out there in California and Vegas, which of course are markets where we've seen a markedly higher price level.
Exactly. And in our business, we have a business that we're super proud of that takes a home that has been well lived in for 30 plus years and needs a roof and needs a new water heater and needs a new air conditioner and would benefit from new bathrooms and new insulation and oftentimes things like new windows. And we bring those homes up to a market standard without having to build another home. And we just can't say enough that reviving a home is way better than building a home because of where it is and the impact on the environment and the speed to market. And the average home, Romaine, in the United States was built in 1977. So the average home in the United States is almost as old as I am, and you know that means that it's banged up. So we have a business of bringing that supply back to market.
I do have to ask you just about economic conditions, and not just because of the recent spike in energy prices, but even prior to that, there was a lot of concern about whether we were looking in the face of a potential economic slowdown. If one does materialize and it actually worsens affordability overall across the board, not just for housing, but for everything, particularly for middle income and lower income people, where does that put you, Sean? Is that something that you can capitalize on, or does that sort of potentially hamper your business?
Yeah, like we bet on America and we bet on Americans. So we certainly we're not going to benefit from really what you're talking about, which is stagflation. I think that's the biggest risk is that we have inflation in energy costs and inflation in goods while we have a deflation in labor. And I think that's the big risk to the market. And that hurts everybody. It hurts us a lot, and it hurts financial markets, it hurts hard assets, and it hurts consumers. And I think that's the thing the government should be sort of on the prowl for, and the Fed should be on the prowl for, is that what do we do when the things we're doing internationally are causing energy inflation, and this tremendous build out of AI is causing material inflation, and at the same time, there's a threat that AI is going to bring down wage inflation, and that's the thing that hurts everyone.
All right, Sean, always a sobering conversation. Always appreciate you taking time. Sean Dobson there, the CEO over at Amherst, a closer look there at the housing market. And he did talk about what we're seeing, of course, in the energy space. We're still looking at elevated prices across the board for all of the major energy commodities. In fact, up about 40% for crude oil since the war began, 50% for some of the key heating oils, gasoline, diesel as well, even natural gas up about 6%. When we come back, we're actually going to talk to the CEO of one of North America's largest energy infrastructure companies to talk about exactly what he sees as both the opportunity and risk ahead given the war in Iran. That conversation coming up next here on The Close, right here on Bloomberg. 3:30 p.m. here in New York. This is the countdown to The Close. I'm Romaine Bostick.
And I'm Isabel Lee.
And we talk about a market that is trying to sort of find that light at the end of the tunnel. Isabel, yesterday we saw a lot of the dip buyers come in. We're seeing them again here today. And a lot of that seems to be that direct correlation between oil prices, which are still elevated, but I guess you can say maybe a stabilized, at least for the last couple of days.
It has stabilized, but oil has risen 40% since the war started, which is pretty remarkable. I think it's the most volatile. All my notes every day when I check, it's about how volatile oil has been and how spooked traders are. Absolutely, and that's obviously going to be a big driver. We did get settlement just a little while ago with ICE Brent right around 103 and change, and WTI crude here in New York at 96.21. As we move closer to the closing bells, and we want to talk about that intersection between what we've been seeing in the cross-asset space and the energy space. And we're going to do that with our next guest, who runs one of the largest energy infrastructure companies in North America. François Poirier is CEO of TC Energy, and he joins us here in Studio 2. Great to have you here, François.
My pleasure.
Fresh off ringing the opening bell to celebrate your 75-year anniversary, not your personal 75-year anniversary, you're a lot younger than that, but 75 years for TC Energy. Congratulations.
Thank you.
We talk about a company, Canadian, obviously, in terms of its roots, but you do about half your business in the U.S., obviously your natural gas pipeline, kind of your crown jewel here. Talk a little bit about whether you've seen any impact at all from the increase that we've seen in oil prices, and more importantly, the disruptions that we've seen in LNG, oil, and other things coming out of the Middle East.
Well, we move about 30% of the natural gas across all of North America, Canada, the U.S., and Mexico, and to all coasts of the continent for LNG export. So when you see the type of disruption we've had in the Middle East, it certainly reminds everyone of the importance of energy security, and buyers are looking to continue to diversify their sources of supply. So obviously infrastructure takes many years to develop, but you have to start sometime, and looking for various delivery paths to different markets around the world. North America looks interesting and attractive, and whether it's in Canada or in the U.S. Gulf Coast, or even on the west coast of Mexico, there are competitive advantages, particularly for delivery to Asia from North America.
I am curious if we are going to see a material shift or a material increase in infrastructure build out. There's been a lot of people trying to make comparisons to what we saw in COVID with supply chains and how that kind of forced a lot of companies and governments, for that matter, to sort of rethink exactly how those supply chains work. Is this event, what we're going through right now, particularly if it is prolonged, can that be that same catalyst for a relook at energy infrastructure?
Definitely, not only from the perspective of LNG exports, but natural gas for power generation to meet data center demand. So there's an impetus for significant increased investment in natural gas pipeline infrastructure and in power generation infrastructure to meet quite significant growing energy demand in North America. That's going to need streamlined permitting to attract the capital that's required to actually grow the American economy.
You mentioned data center demand. They're actually really huge, giant energy users. How much of that is actually translating today into new pipeline capacity that you're seeing?
Well, we have sanctioned a number of projects. We have $8 billion of projects committed today to the U.S. marketplace. And the majority of those have a data center component to them. There's a lot of just general electrification that's being added as well. If we look at the projects that are on the drawing board right now, where we are talking to developers about, we could add another $8 billion of sanctioned projects here in the next 12 to 18 months, where data centers are the ultimate customer for a significant portion of that investment.
So what then are the most immediate or biggest bottlenecks you're seeing? Is it permits, pipes, connections to power?
Well, on permitting, it's simply we need things to move faster. It's challenging right now, given the permitting timelines, for infrastructure to be built quickly enough to keep up with the demand growth. On the power generation side, I would say that it's more challenging on the supply chain side. Power generation turbines are long lead items that require many years for delivery, and that has slowed down some of the development work that we've done on the pipeline side, simply because it's the gating item. But again, the global market is responding to that. We're seeing turbine manufacturers invest capital in new manufacturing capabilities. And I have never seen the pace of investment opportunities for us grow as quickly as it's been growing over the last 12 months.
Have you run into any issues, given some of the political conflicts between the leaders of the U.S. and Canada, in being able to see these projects, or even just sort of even to really plan out these projects, given how long-term they would have to be?
Well, if anything, energy has been exempt from some of the trade tensions between Canada, the U.S., and Mexico. And I think it's a recognition by all three governments of the importance of the free flow of energy across borders to support the reliability, energy reliability of each of the three countries. There's an explicit exemption, provided you meet rules of origin, for under the USMCA agreement for energy flows across the borders. In fact, more energy flows back and forth across the US-Canada border than any other border in the world. And we would expect, I can't predict how the USMCA will evolve or unfold over the next few months, but we would expect, given the energy literacy of all three governments, that the free flow of energy will continue, irrespective of what happens.
So you haven't had to rethink any potential investment plans or anything like that as a result of it?
No.
Has there been any discussion about things other than natural gas? I know you do have some nuclear capabilities in terms of other types of power, particularly for servicing some of these data centers and other AI build-outs.
Very much so. In the province of Ontario, where we own approximately half of the largest operating nuclear plant in the world, we are in the early stages of planning a significant expansion of that facility. Partly to meet electrification growth, and data center demand growth is part of the equation there as well. Those, of course, take many years, if not a decade or more, to develop and put into service. But those plans are accelerating as well.
30 seconds here. When it comes to LNG, is Canada in a position today to step in as a supplier, or is infrastructure still a constraint?
Canada has the resources, has the know-how, and I firmly believe that Canada can become the largest exporter of LNG to Asia, given the resource and given the focus of the Canadian government on diversifying beyond the U.S. economy. There's a huge opportunity for Canada.
All right. Thank you so much for joining us here on set, François Poirier, CEO of TC Energy. Coming up, airline stocks taking flight, Delta in particular soaring after raising their first quarter revenue forecast. We'll take a closer look up next during today's Stock of the Hour. This is The Close on Bloomberg. Airline stocks flying high. U.S. executives say they're seeing strong booking trends as travelers try to purchase their tickets before fuel costs increase fares. Delta is up around 6% after raising their first quarter revenue forecast, saying they now expect high single-digit growth. Joining us live is Bloomberg Markets correspondent Norah Mulinda. Norah, thanks for joining us. So what is behind all of this optimism?
So, of course, we've been seeing all the ongoing conflict in the Middle East. That's really been pushing oil prices up substantially. As you'd imagine, of course, that actually ends up raising the cost of fuel for a lot of these U.S. airlines. And you're seeing some of these executives at these major companies like Delta, American, United Airlines, companies coming out essentially saying that they're seeing a rush of people, whether it be some of the premium travelers or business travelers that are actually just trying to snap up tickets, essentially trying to get in front of the idea of their ticket prices surging later down the road.
This gets to the idea, though. So have we actually, I mean, I know it's only been a couple weeks since the war started, and we have seen a material jump up in jet fuel costs and other residual costs. Is that actually going to start to show up at all in their financials, or they're basically saying we're going to raise our fares enough to cover that, cover whatever increase?
Right. Well, it's interesting because if you think about U.S. airlines, they don't really hedge for fuel costs in the same way that their European counterparts may do. And so we see them to actually really depending on potentially looking at the people that are going to actually be being on the flights and really thinking about other alternative strategies as opposed to the hedging that European companies tend to do. But I mean, they're also in this period right now where they're navigating really complicated flight routes, whether it's trying to avoid some of the routes around the areas that are involved in the conflict. But also separately, we have the fuel prices that represent about a third of their operating costs. So we are kind of seeing them trying to figure out what this is going to mean in terms of the impact, particularly on the bottom line.
I mean, listening to the commentary from this conference that most of these airlines were presenting at, I mean, I was actually struck by the tone, which seemed very upbeat. I mean, you would have thought that there would maybe have been a little bit more caution, a little bit more navel gazing, if you will, but it's basically just full speed ahead for these folks.
Right. I mean, we did see Delta. They said that they saw a $400 million spike in fuel costs so far this month, but then we also have Delta and American saying that they saw their best ever single day sales in March. So to your point, while you would maybe expect people being a bit bearish ahead and people really being concerned about how much this will actually weigh on financials, you still hear a lot of these executives at these major companies saying that they are optimistic about the future, and they do think that essentially the idea of these fuel costs really rising, it's actually really pushing people to get their tickets bought and trying to figure out the travel for the future as we head into the end of the year.
So it looks good for the companies now. People are rushing to buy tickets before they become more expensive. Have companies talked about what will happen to demand after they already become expensive?
And I think that's the interesting part, because I mean, if you think about, a lot of people spend a lot of time booking flights during the summer. We know that's a really strong period for some of these companies. But what I found to be particularly interesting, we did hear American Airlines saying that this is kind of the higher fuel costs are hurting their bottom line. American also said that they expect results toward the worst end of their first quarter loss forecast. So they say adjusted loss per share is seen closer to 50 cents versus the prior range of 10 to 50 cents range. So it's really interesting to see how some of these companies are thinking about it and whether or not this is just a thing of fundamentals and you're seeing strong demand because of the period, or if it's people trying to get in front of the ticket prices really surging and just trying to catch a deal, if you will.
Yeah, and somebody who's recently bought tickets, I feel like they were already surging even before
they were already
the war.
surging.
Like, I don't know what they're doing. I mean, I guess they just have us, they have us by the neck here. They can do anything they want, but still, it looks like jet fuel prices, I mean, we're up something like 60% since the war began, and no one really sees an end in sight just yet here. I'm interesting to see the dichotomy right now between that continued elevation in prices and obviously this rally that we're seeing in some of the airline stocks. Norah, Mulinda, our Bloomberg markets correspondent, counting us down to the closing bell. And Isabel, this gets to the idea of where the leadership in this market will be if this war does continue on. Are we going to still look to energy stocks? Is it maybe going to be some of the consumer cyclicals potentially if that ends up being a bit more of a safe haven?
We're definitely seeing a rotation into the market, and the traditional safe havens, they're not anymore acting like that. You see the tech, a lot of mutual fund managers are shifting away from that and moving into more safe investments in sectors.
All right, fractional gains for the major indices, but still up for a second straight day. We're going to break down all that's happened in this last couple of weeks and hopefully get some insights into maybe where we go next. Jay Jacobs, U.S. head of equity ETFs over at BlackRock. He joins the big program in a second, right here on Bloomberg.
There could be a big relief rally, so people don't want to miss out on the rally. And also, historically, they've learned to look past geopolitical issues. But this time around, it seems the scale, depth of this crisis are greater than what we've experienced in recent years. And so a lot depends on the duration of this, of this conflict.
Jimmy Chang over at the Rockefeller Global Family Office kicking us off to the close just about 50 minutes ago with investors trying to call a bottom in this market. We should point out, Isabel, the gains today are fractional compared to what we saw yesterday, and the volume is actually significantly lighter.
That is fair, but you're still seeing green on the screen, Romain. Stocks staging a cautious advance, most shares in the S&P edging higher. We have traders really just choosing to look through the potential implications of higher oil prices. You see oil there also up, popping by more than 3%, although easing from session highs. You see a collective sigh of relief as traders who are now really worried about the implication of higher oil prices on inflation. And yields there are slightly lower by just a touch, actually, by nearly 2 basis points. As we know, we have the Fed rate decision tomorrow. Investors are expecting the Fed to stay pat. And lastly, Bitcoin up by 0.4%. It's been hovering around the 74,000 level for a while, kind of an oasis of calm, Romain, relative to the volatility in stocks and oil.
Yeah, right now, we should point out about 8 of the 11 S&P sectors are in the green, but your big gainers today, you're actually going to find them, as we were just talking about, in the airline and the travel space, and you're still seeing a big pop in some of those memory makers. In fact, Western Digital, that's your percentage outperformer in the S&P on the day, up 9% right now, heading into those closing bells. Joining us right now is Jay Jacobs, U.S. head of equity ETFs over at BlackRock, to talk a little bit more about some of the recent market moves. And Jay, I do want to start off just in general with some of the flows and sentiment right now in markets. I know we've kind of gotten a little bit away from, I guess, that initial knee-jerk reaction to the war in Iran. And now I think people have kind of settled in with this idea, trying to parse exactly how long this goes on. And more importantly, the idea of whether there are going to be any real ripple effects for the U.S. economy and, for that matter, for U.S. corporate profitability. What are you seeing?
Well, we can see it in some of our client polling data that previously clients had been much more bullish. In fact, over half of financial advisors in the U.S. were positioned bullishly just a few weeks ago. Now they're coming more into sort of a moderate, wait and see sort of approach towards the market. That's really channeling flows towards a couple of areas. One is we're seeing a shift in sentiment from a little bit more away from the U.S. and towards international with some of our clients. And we're also seeing more of a focus on diversifiers in the portfolio, taking a little bit less equity risk, focusing on things like liquid alts. The third area is people looking at defensive positioning through option strategies, looking at buffer ETFs that can provide a measure of downside protection. So this isn't, a risk-off environment. This is just a shift from more bullish positioning into a bit more moderate positioning and looking for diversification.
Do you get a sense here that with some of the positioning shifts that we've seen, that they are going to be extended or, I guess, prolonged, or is this a little bit more tactical, a little bit more short-term until that fog of war finally lifts?
I think some of these things that we just discussed are actually likely to be longer term. I think that if you look over the last several years, the heavy emphasis on U.S. equities over international, we're going to see the pendulum swing back a little bit. We're going to continue to see an emphasis on diversification, particularly as stock-bond correlations continue to be high. And then I think you have a demographic shift of so many people entering retirement that just don't really want to see these bouts of volatility. They want to mitigate it when they can, and that's where those buffer strategies come in. So I actually think maybe this is because of it's more of a near-term reaction, but I think a lot of this positioning might stay for the long term.
Jay, you and I live and breathe ETFs. You have the largest AI ETF. The ticker is BAI. Where are you seeing the next phase of AI investments beyond the big names like NVIDIA?
Well, we're seeing it happen right now with the broadening of chips, right? The memory chip crunch has certainly, focused on other areas than just GPUs in the market. But we're also starting to see more adoption of artificial intelligence across the economy. So some of the areas that are really interesting are just companies that are adopting AI, using it to improve their products or improve their margins. And we're also seeing a lot of focus on power and power infrastructure. So really looking at the inputs going into data centers as a major way to play AI, but outside of the technology space.
Your ETFs in the crypto land, IBIT and Ether, those are your ETFs tracking Bitcoin and Ether, are seeing strong activity. What are you trying to get from that? What are you reading from your investors when it comes to conviction, when it comes to the crypto space?
Well, the big news this week is we brought out a third product in the space, which is ETHB. This is our staked Ether product. So this is looking at, not only providing the price return to Ether, but also some measure of income based off of staking that Ether. And it's been off to the races. We've seen, on average, over $45 million traded each day just since it launched a couple of days ago. We're seeing some really strong flows. This is really about providing investor choice. We know that there's a lot of investors out there looking for digital asset exposure in the ETF structure. We've done it with Bitcoin. We did it with unstaked Ethereum, and now we're doing it with staked Ethereum. So this is really about expanding our product lineup, and there's been a tremendous amount of interest early on.
Obviously, a lot of breadth, of course, under that BlackRock portfolio. I do want to go back, Jay, though, to the equity space and also this idea that some people have talked about with regards to the moves that we've seen in this market and the idea that people want a little bit less sector exposure, if you will, and more single stock exposure as well. Does that sort of work against some of your ETFs, or do you also sort of have something that can actually cater to those types of folks?
Well, Romain, I would agree with maybe a little bit less sector exposure, but where it's going is more towards thematic exposure. People are looking at things like infrastructure, looking at artificial intelligence, looking at geopolitics. And these are themes that are not very well captured by using a sector-based approach. This is part of why we've seen billions of dollars come into our AI ETF, BAI, as well as you were mentioning. It's why we've seen a tremendous amount of flows into our infrastructure ETFs like IGF. People understand the world is changing, but the tools that you need to access those changes are evolving as well. And that's where thematic ETFs have really become a key tool in portfolios just in the last several years.
So a lot of the structural themes that sort of existed prior to the war, whether it was the AI theme and even the alternative asset theme, obviously two themes that, of course, have had some cracks, to be sure. But you anticipate that those longer-term structural trends for those uptrends, I should say, that is still relatively intact?
Oh, absolutely. I mean, let's look at what's happened year to date so far. One of the big shifts has been leaving the tech sector broadly and moving into AI stocks in a more focused thematic way. And this has really proven out with what we've seen with software stocks, which is just broadly buying the tech sector is not a very precise way of capturing the winners from the AI trade, because in that basket, you might also find some companies that are likely to be disrupted by artificial intelligence. So taking a thematic approach that really hones in on the winners is a really important way to think about portfolio construction. Yeah. And if you're doing thematic investing right, you're looking at the long term, not just near-term news events.
All right, Jay, that'll leave it there. Jay Jacobs, U.S. head of equity ETFs over at BlackRock. And we should point out, we actually did have an IPO today in the AI space, in the drone space, basically mashing up two worlds that investors have been salivating over. Swarmer selling at $5 a share last night, opening at $12.50. The shares halted right now at $29.06. A full breakdown of all of today's cross-asset market action with a global simulcast that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romain Bostic here with Isabel Lee in today for Katie Greifeld. We're taking you through to that closing bell. It's a global simulcast. Carol Massar and Tim Stenevec join us now. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. Day two here of the rebound rally. Carol Massar, though, a little bit fractionally different than what we saw yesterday.
Yeah, I do feel like it's limping along a little bit here. We are near our worst levels of the session, even though if we're seeing a lot of green on the screen, courtesy of St. Patty's Day, perhaps. But having said that, I am really curious what the Fed has to say tomorrow when we get that.
Did you go out to the parade today?
I did not. Although, can I just tell you, we have been so wacky that our team put in our chat the poster for Dumb and Dumber.
I think that's what they were calling us. That's what That's what they were doing.
Yeah.
That's okay.
We
wear the badge with pride.
Yeah, we do.
It's interesting to see what's happening with Bitcoin and what has been happening with Bitcoin over the last couple of weeks. While the S&P 500 is down about 2% since the start of the war, Isabel, Bitcoin is up about 13%. It cracked through the $75,000 per Bitcoin ceiling yesterday. I don't know what it says. Maybe, folks are thinking this could be a return to a safe haven play, but
how much are we down on the year?
Yeah, it's still down about 15% so far this year. 15.
Yeah. He does do a crypto show.
Yeah,
so I've heard.
Tuesdays I talk crypto.
Talk in his book. What can I tell you?
It is Tuesday. So no crypto tomorrow?
No, we had it already today.
Come on in here, Isabel.
The animal spirits is really there because the market's willingness to trade higher in the face of oil prices really just reflects the strong demand when it comes to stocks and maybe expectations for strong earnings down the line. And I guess economic growth as well.
All right, we get the closing bells here in New York. Now, we should point out here the volume it is light. In fact, it's actually been dropping the last couple of sessions here. In fact, we're down roughly about 12% from where we were in yesterday's session. The gains also a lot more limited than what we saw yesterday. Fractional gains across the board. It is green across the screen with the Dow up about 47 points or 0.1%. The S&P up 17 points or 0.25%. The NASDAQ composite up about 100 points or 0.5%. And the Russell 2000, that's your relative outperformer, Carol Masser, adding about 17 points or 0.7%.
All right, certainly interesting there. All right, let's go back to the S&P, the big caps, if I may. And you do have most names in the S&P 500, Isabel, higher today. 314 names actually gaining ground on this Tuesday, 185 to the downside and 4 unchanged.
You see that reflected in sector performance. The winners is obviously they're overpowering the losers. So you have the financials up by 0.8%. Energy, not a surprise, up by 0.6%. And communication services also in the green. Let's name some losers. We have consumer staples down by just 0.1%. Materials and healthcare also just slightly lower by also nearly just 0.2%.
All right, guys, let's go to some of the individual gainers. Taking a look at Uber and Lyft, both higher in today's session. Uber up about 4.2%, Lyft a gain of about 3.8%. Both of them rising as the rideshare firms and NVIDIA announced separate autonomous vehicle partnerships. RBC Capital Markets weighing in, noting the two, Uber and NVIDIA, expanded their partnership, and they're saying that Lyft's PAC focuses on the company adopting their NVIDIA's accelerated computing capabilities, building a next-generation mapping platform. Both of the announcements reinforcing RBC's view that the ride-hailing companies will have a durable moat when bringing together many AV providers for optimized utilization on a platform that runs a complex combination.
Wow. Who wrote your script here? Is that a PR guy or something? What's happening? Wow.
It's like a press release.
It's like a LinkedIn page come to life here. What's happening?
Anyway, Uber is going to launch a global fleet of NVIDIA software-driven autonomous vehicles across 28 cities globally by 2028. Let's move on, shall we? All right, let's talk about...
You've written in one of those things, Tim.
Oh, yeah. Those things are great.
Have you not done a Waymo yet?
Yeah, I did one.
Oh, okay.
Yeah.
Have you, Isabel?
No, I think I'll stick to a car driven by a human.
No, you won't.
You will love it.
You'll love it.
No going back.
Truly.
Just telling you. All right, let's get to airlines real quickly. S&P Airlines, Super Composite Airlines Industry Index up about 4.1% today. We really have seen the airlines come out and talking about strong booking trends as travelers are buying tickets before rising fuel costs increase fares. Delta also offering an encouraging signal about the strength of the economy after raising its forecast for revenue for the first 3 months of 2026. It said it's seen demand to fly accelerate into March from both businesses and households. American Airlines also up after saying it's also likely to report stronger growth in revenue for the start of the year than it had forecast earlier. So take a look, guys. We're looking at Delta up about 6.5%. And
this is like the ultimate hedge, right? That if you can afford it, because you're going to pay more for tickets. Do you just buy like the airline stocks as a hedge to sort of offset how much they're going to gouge us over the next few months? Am I allowed to say that?
Well, you already did.
Okay. All right.
Moving along.
All right, let's talk a little bit about some of the prominent decliners today. One of the worst performers on a percentage basis in the S&P 500 today was Eli Lilly, ticker LLY. HSBC turned bearish on the stock. It said investor expectations for weight loss drugs are overinflated. Bankers or analysts at the company, I should say, cut the drug maker to reduce and slash their price target on the stock to $850. Right now trading at $930. It said that Wall Street is too optimistic on Lilly. Shares fell today by close to 6%. Also, taking a look at NVIDIA on day 2 of GTC. That's NVIDIA's developer conference taking place in San Jose, California. Jensen Huang said that $1 trillion projection that we talked about yesterday, that was for AI chip sales, and it doesn't capture other product offerings, even though that is the majority of the company's business. He expressed strong confidence of $1 trillion plus in business that the company expects to close, book, and to ship. The company plans to shift more of its cash for investor returns, such as buybacks and dividends, during the second half of the year. Shares of NVIDIA fell today by about 0.7%. And then Nebius Group. Look at this. Nebius Group. This has been on a tear this year, down 10.4%. This after the company said it intends to raise about $3.75 billion in convertible debt to use for its data center expansion and to purchase customized chips. Nebius shares fell. The stock closed up 15% yesterday. That gave the company a market value of roughly $33 billion. This is one of the neo cloud providers.
Yeah, interesting. And let's just check in on yields. Not a whole lot going on there. In fact, a bit of calm in the Treasury space here. You saw yields just slightly lower across the board, at least on the longer end of the curve, down by 1 to 2 basis points. Of course, the Fed kicking off its 2-day policy meeting earlier today. The Fed decides that decision 2 p.m. Washington time tomorrow.
All right, guys, let's get to DocuSign. Just crossing the Bloomberg terminal, popping up about 5. It's bouncing around, but it's definitely rallying here in the aftermarket. All right, their earnings just crossing the Bloomberg. Let's get to it. Fourth quarter revenue, it is a beat, $836.9 million. The street estimate, $828.2 million. Fourth quarter subscription revenue also coming in better than what the street was expecting, $819 million versus a street estimate of $810.4 million. DocuSign announcing a $2 billion increase to its share repurchase program. And then let's go to fourth quarter adjusted EPS. That too came in 6 cents better than what the street was expecting at remain $1.01 a share.
Yeah, and this, of course, is one of those stocks that kind of got battered around. I think it was down something like 30% this year coming into today because of some of the concerns about disruption in the AI space here. So it'll be interesting to see here if they are finally, at least in the eyes of investors, back on track. Tim?
Well, speaking of back on track, Lululemon, that's what investors want to see when it comes to Lululemon after Calvin McDonald stepped aside earlier. Shares down by about 1.7%, now higher by just about half a percentage point. Fourth quarter earnings per share did beat estimates. In terms of numbers, fourth quarter EPS coming in at $5.01. That beat estimates of $4.78. Fourth quarter net revenue coming in above estimates at $3.64 billion. Gross margin for the fourth quarter barely beat revenues, 54.9%. Fourth quarter international comp sales, excluding FX, was up 16%. That beat estimates. And America's comp sales, excluded FX, that was down 2%, but the estimate was for down more than 4%. As far as the outlook, here are the numbers. The company sees fiscal year net revenue 11.35 to 11.5 billion. The estimate was for 11.5 billion, so it's the upper range of the forecast, did reach that estimate. Lululemon shares down about 0.5% in the after hours. Oh, the company also sees fiscal year EPS 12.10 to 12.30. The estimate was for above that, $12.59. So a miss there. Shares down about 0.5%.
That's what I want to mention too. It looks like Chip Bergh, the former CEO over at Levi Strauss, is going to be joining the board effective immediately here. So that could be intriguing, particularly when we talk about the idea that we have two interim co-CEOs running this company right now, and a lot of speculation as to when we might hear an announcement about a permanent CEO. Speculation, Tim.
Yeah.
Carol.
But it's what everybody cares about, right, when it comes to this company and the way forward. So we'll see. I'm kind of been just looking at the press release to see if there's anything more on that.
Nothing?
Not so far. That speed reading class apparently not paying off. All right, guys, that is a wrap. But we are definitely watching these stocks in the aftermarket. That's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals, Isabel and Romaine continuing there on The Close on TV. Tim and I back here on Bloomberg Business Week Daily right here on Bloomberg Radio. Folks, we will see you same time, same place tomorrow.
And our coverage continues here on Bloomberg Television. A deeper dive into those results out of Lululemon. Jharonne Martis is going to be joining us in just a second. Stick with us. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Markets have closed here in the U.S. Fractional gains for most of the major indices, 0.25% on the S&P. But frankly, this is one of those days where you might as well just call it unchanged. Not much going on in the yield space, a bit of a holding pattern for the dollar as well. And while you did see a slight uptick in crude prices on the day, still camped out in that tight range of where they've been for the last couple of days. 103 on Brent crude, 95.96 on WTI. As far as the individual stories, NVIDIA at that GTC, day two of that, not doing much to impress investors, but investors did see an opportunity to claw their way back into some of the stocks that had beaten down. Blue Owl getting a bid of about 5% on the day. Delta up more than 6% on the day after giving a relatively bullish commentary at that conference that's been going on with most of the other airlines. And keep an eye on the apparel space. Remember, they as a group, they had dropped about 10%. Remember, that jump in oil prices, it kind of hits them on two levels, both in terms of distribution costs and, of course, how it weighs on the potential for consumer spending. A modest rebound here on the day with Ralph Lauren, one of the exemplaries on the day, up about 3%. And that actually brings us to our top story for the hour. Lululemon and the power and peril of a pioneering brand. And I'm not talking about category killers, but the category setters. You think about Coca-Cola's bottled soda, Sealed Air's bubble wrap, Netflix's streaming service, and BlackBerry's, well, BlackBerry. Lululemon is in that pantheon, turning yoga wear into a niche luxury and then turning that into a global athleisure phenomenon. But starting a category, it's often easier than holding on to it. Nike and Gap, they've muscled into that space, and startups like Fiore, Skims, Alo have all seemingly come out of nowhere to become billion-dollar competitors. Meanwhile, Lululemon just reported its smallest annual revenue growth since it went public about a decade ago, a fourth straight year of slowdown. Margins are also narrowing and net income contracting. CEO Calvin McDonald, he was pushed out 3 months ago with no succession plan in place. And that's kind of funny because his predecessor walked the plank in 2018, also with no succession plan handy. And his predecessor in 2014 found herself on the outs with no backup ready. In fact, the company has actually struggled with its identity and strategy since its controversial founder was pushed out himself back in 2012. And that may be the real story here. Inconsistent leadership. And with so many companies crowded into the space, there are some big questions as to who will lead Lululemon against the competition into whatever the next era turns out to be. Joining us right now is Jharonne Martis, Director of Consumer Research over at LSEG, to talk a little bit here about leadership and about the numbers that we just got. Not bad numbers. They did beat on a couple of key metrics, and they did provide guidance relatively in line with estimates for the full fiscal year, the fiscal year that we're now in for 2027. Let's start with the numbers first. Were you impressed, surprised by anything you saw here?
Definitely better same-store sales than expected. And what is pretty remarkable about Lululemon is that they have now beaten earnings for 23 consecutive quarters. So that in itself is pretty impressive in this climate. Now, having said that, as you mentioned, they are facing significant more competition, which has hurt them. And especially the promotional environment has been the key issue for them, especially because a decade ago, you used to go into a Lululemon and they didn't offer a discount because they didn't have to. And over the past year, they're becoming so promotional that it's actually been hurting some of that brand image. And that's the biggest complaint we've been hearing about analyst poll by LSEG.
Do you think that we're going to see a little bit more discipline when it comes to pricing, inventory, et cetera, out of them?
So the issue is that since the pandemic, the consumer has been dealing with tariffs, economic pressures, now a weakening labor market. And, so the consumer has now been conditioned to only open up their wallet if they find a value. This earnings season has main theme has been affordability. The consumer has been so discerning that they won't open up their wallet unless they find the value proposition. And that's really, truly what made Lululemon have a good holiday season, was the fact that they were able to offer some discounts without hurting the bottom line too.
Do you have faith right now, though, in management? I mean, we have two interim co-CEOs right now, assuming at some point we'll maybe get some an announcement on who the permanent CEO will be. But this is basically a company that, at least for the last 3 months, really hasn't had any real, no disrespect to them, but no permanent leadership.
That is correct. And that is one of the biggest concerns by analyst poll by LSEG. Having said that, I've been covering this for over 2 decades, and with the right management, we can see a company turn around. So today's earnings call is actually that the emphasis will be on what's going to happen to leadership and also what is happening in North America, because internationally we're seeing that Lululemon continues to thrive, especially in mainland China. But in the United States, like you mentioned, they've been losing a lot of the market share.
Well, on the leadership front, and we should point out that there is a Chip returning to the board of directors, not Chip Wilson, the founder, but Chip Bergh of the former CEO of Levi is going to be joining the board of directors, which I guess is a good sign. I mean, we don't want to speculate too much as to why he's there, but obviously a veteran in the retail space. He knows how to run a company and he knows how to turn around a company. So I would think just his presence on the board would give investors some degree of confidence.
Absolutely. Yeah. So we'll have to see the stock reaction and what they say today during the earnings call. But that in itself, yes, he is a reputable person that has turned around companies in the past, and it is definitely a positive sign.
I do want to talk about just competition because, I mean, you go back and, you know, Lululemon was kind of the only game in town if you wanted high-end yoga wear, athleisure, whatever you want to call it. And you, at least in a city like New York, I mean, you know, there's a Lululemon on Fifth Avenue, and there's an Alo, I think, a few doors down, and,
right.
You know, Athleta and something else I'm probably forgetting. And then this morning, I just walked past the flagship Nordstrom store, and they have this huge first floor display for Skims.
Yes.
And it's impressive. I hadn't seen it in a while, and I was just like, holy cow. And you just think about all these brands that didn't really exist, you know, 10 years ago that have now really just dominated, if not revenue-wise, certainly they've dominated in terms of attention.
And it's not just the names that you've mentioned, but also within the discounting space. We have Target that has its own brand, and even Amazon, who is selling the exact same merchandise at a fraction of the cost. And when you have the macroeconomic environment that we have right now, that's where the consumers are gravitating. They still want designer clothing, but for less.
Do you think Lululemon should compete on price, though?
So that's where management is going to be key. Like they are going to have to reinvent themselves to what really do they want to continue to be, the brand that continues to cater to the high end. High end, by the way, is they're still engaged with Lululemon. It's the aspirational middle class consumer that is going elsewhere because they are definitely feeling the pressure of the times. So that consumer is going to Alo, and Alo is making those conversions. Now, think about Lululemon. They were known for the $100 pair leggings.
Yeah.
And so is Alo, but Alo is mostly known for the athleisure, the loungewear, and that sells in pairs. So as a result, you're seeing that Alo Yoga is having a much bigger basket.
Yeah.
And those sales are turning out much bigger than Lululemon.
Yeah, I feel like when I walk around New York City, I think every woman in New York City is wearing Alo now, apparently. But anyway, that's something to keep an eye on. Of course, we're keeping an eye on the shares as well, down about 2% as we wait for that conference call to start. Jharonne Martis is Director of Consumer Research over at LSEG, helping us break down those earnings. When we come back, we're going to actually talk beverage space, and we're going to talk, well, aluminum. Spindrift CEO Dave Burwick is going to be joining us about his new venture. Well, it's, expansion into tea. That conversation coming up next here on The Close on Bloomberg. All right, results out of Lululemon, keeping the spotlight on the consumer, and our next guest saying consumer behavior is evolving in a more inflationary environment. Some shoppers are looking for more value, others, they're still willing to trade up for premium products that they, well, quote, feel good about. Dave Burwick is the CEO over at Spindrift, and he joins us now fresh off launching the company's first non-sparkling beverage. I want to start there here. I mean, your company, I don't know, what are you, like 15, 16 years old? We kind of know you for the sparkling waters that you have. But just over the last couple of weeks, you've started to roll out a tea. Why, Dave?
Yeah. Well, thanks for having me, by the way, Romaine. I think the tea category is a really interesting category. It's a $5 billion category. It's been around for a long time. It has a very healthy halo to it. And actually, there's been very little innovation over this category over the last 5+ years. So we think there's an opportunity to really get consumers excited again about tea and bring a new product. And in this case, with Spindrift, we're all about real squeezed fruit. So when you bring real squeezed fruit to real brewed tea, it's never existed before. And it just gives a different drinking experience. It's really smooth. You want to drink a lot of it. It's good for you. It's new for us because it's non-carbonated. It has a little bit of caffeine, normal caffeine levels for tea. And we think to take a big category and bring news to it, you can really reawaken it. And we're very excited about this opportunity.
Well, I am curious about the marketing side, Dave. I mean, you know, when I go to the grocery store, I mean, the displays of sparkling waters and teas and other beverages, I mean, it's immense, it's vast. And I am curious as to how you make sure that your brand actually stands out.
Yeah, well, I think you just said, I think you want to get displays. You want people to basically trip over your brand when you can. So part of it is working with retailer partners and making sure that we get the right price points to start. We get display activity. We get visual inventory landscape in the store so people can find us pretty easily. And then, of course, you have to come over the top of that and drive brand awareness. You have to invest in advertising, whether it be paid social, digital, traditional TV advertising. You have to create some awareness and buzz for consumers. So when they come into the store, they're looking to find your product.
I am curious just about generally how, your pricing of the product and the idea that we are, at least by some accounts, in an economy where you have certain consumers, a huge swath of consumers, if you will, that are a little bit more cost conscious. They're looking at discretionary items in a way that maybe they wouldn't have looked at a couple of years ago. And I am curious as to how you sort of hold the line on pricing to sort of keep those people tethered to the brand and not scare them away.
Yeah, I mean, we're very aware of that, of course. And I think we definitely live in a bifurcated environment right now where you have some people who of means can trade up for premium products. Other people are trading down for value. I think the benefit of being in our category, which is a better for you health and wellness space, people, even lower and middle income households, are looking to trade up if there's a health benefit or if there's a brand that they identify and they think is valuable. So we actually track very carefully monthly low, middle, and high income households and how much they're buying our product. And we've been looking, actually expecting maybe lower income households to fall off the pace a bit. We haven't seen it yet, but it's something we're very acutely aware of. And we need to make sure that we're addressing the needs, not just of the high end of the K, but also the low end of the K.
Have you seen any issues right now, at least in the short term, Dave, with regards to your costs potentially going up? Obviously, with the war in Iran, there's been a lot of focus on energy prices, but of course, aluminum prices have risen as well. Have you anticipated or started to model in the idea that your production costs might actually be higher later this year?
Yeah, I mean, certainly on the aluminum front, we've been hedged for about 6 months or so now. So we got in pretty early on that one and didn't want to risk not knowing what our costs would be. So we'd rather take maybe in some cases a little bit higher price for the predictability. Now with the war in Iran, we're expecting obviously freight costs to go up. And so there's not much we could do about that other than find other areas to cut costs. I mean, I've never spent so much time focused on the line items between gross sales and gross margin before in my entire career to really understand what are the elements, what are the drivers, how do we eliminate unnecessary costs so we can make sure that we can deliver value to the consumer and we absorb most, if not all, of those incremental costs.
Well, obviously, you have a very kind of illustrious background in this space. Obviously, you are working at Boston Beer and Pepsi, and I'm probably forgetting a couple others, Pete's, I believe, as well. So you're obviously a veteran in this space, and you've navigated through other economic cycles, other sort of commodity shocks, I'm sure. Does this one feel any worse than those? Is it better, potentially, than what we saw in the past?
I think it's maybe more uncertain, honestly, than it's been in the past. So I think you can't focus on the things that you can't control, obviously. So for us, what we need to do is remember what's our brand stand for? How do we continue to invest in our brand, not cut? When we talk about reducing costs, it's all about things that the consumer never sees. We have to keep investing in our brand. We have to keep doing the things that make sense for the brand. Just keep talking to the consumer. And in this case, with Spindrift going from a sparkling business to now a tea business, we have to look for some adjacencies where it makes sense to actually bring what we do uniquely to another place and to bring new consumers in. So you can't get rattled, and you just got to keep focusing on what is our consumer looking for, how do we give them more of that. And ultimately, in this environment, I think the strongest brands where people and companies maintain their investment levels will be the brands that win.
All right. Well, we have to leave it there, Dave. Well, and obviously you are a seasoned veteran in this space. There's probably a reason why they brought you on as CEO, and congratulations on the new product. And we'll check back in with you soon, I'm sure. Dave Burwick there, the CEO over at Spindrift. As we continue here on The Close, and up ahead, we're going to turn back to the real estate sector. I had a chance to sit down with the Property Brothers. Of course, Drew and Jonathan Scott, you know them from HGTV. They've got a new show, but they also got a lot of thoughts here about housing affordability and, well, what sort of solutions might actually help the situation. That conversation coming up next here on The Close, right here on Bloomberg. Pending home sales here in the U.S. seeing a surprise uptick in February as mortgage rates fell to their lowest since 2022. It's a good backdrop for the new HGTV show from the Property Brothers, Drew and Jonathan Scott. That show is called Property Brothers Under Pressure. It just premiered on Sunday. And it's a deeper look here, not just into the homes, but really into the home buyers themselves and how they navigate a competitive market and make budget-conscious decisions for their new homes. I had a chance to sit down with them exclusively earlier today and talk about the state of the housing market and their journey to HGTV stardom. Take a listen.
It's unlike anything we've ever done, because people always ask us, well, what happens when the cameras aren't rolling? What happens behind the scenes? We show it. You see our crew. You see us disagree. You see moments that the homeowners, I think it's very relatable for everyone out there, because there's so much pressure on everybody.
Well, in an affordability crisis like there is across the country here, the stories, we have 14 episodes, and they're all very different stories. We have families who've lost their house from the fires in LA. We have other families that are trying to pull two families together to live in one house because that's the only way they can afford. We have so many stories that will be very relatable for Americans watching, and we're trying to solve, with really tight budgets, we're trying to solve what everybody out here is trying to solve, to be able to get a home that they deserve.
We talk about the evolution of HGTV and just these types of programs that used to be more about the homes themselves, and they are becoming a lot more about the people and what they're going through. And here at Bloomberg, we've talked a lot about the affordability crisis in the housing market, and particularly out west, where you guys do a lot of your work. I am curious if you've seen any sort of movement in maybe a sort of a future where you have real starter homes, real affordable starter homes for people in some of these markets.
There's definitely been a lot of movement. Unfortunately, it's in the wrong direction. We have, about a 4 million house shortage of a healthy inventory right now. And the challenge is people don't seem to understand that we need affordable housing. Any successful city in the world that has embraced affordable housing, the cities have flourished and the costs have come down. But I love the idea that people can live where they work. And I think some people hear affordable housing, they think, well, that's going to be, drugs and crime and everything. Absolutely not. These are teachers and nurses and police and household workers, people who want to live in the same community that they work. And so that's our goal. From a messaging standpoint, show people that it's okay. You don't have to be a NIMBY. You don't have to stop projects that are being built, in your neighborhood. On the flip side, we've invested in companies like modular builders. So we're trying to find new technologies that will physically bring down the cost of construction at the same time.
Yeah, and the hard time though too, because there's a lot of talk about rate cuts to help the government trying to stimulate. But the problem is, when you have no inventory, cut rates if you want. That gets people excited to buy, but if there's nothing to buy, you're not really solving the problem. We need to find ways to incentivize or make it possible for developers to really focus in. For example, I have a real estate portfolio in Calgary in Canada. The government in Canada really incentivizes builders to do affordable housing, so it makes it worthwhile, and I can keep rolling money from one project to the next to actually make a difference. Down here, I don't have that same opportunity.
Where do you see potentially where those incentives come from? Obviously, in a city like New York, affordable housing has been a huge topic of conversation. It pretty much swayed our most recent mayoral election. I'm sure out west where you guys are, whether it's California, Vegas, Vancouver, you're also seeing similar issues there. Are you seeing things at the state level or the local level that could potentially alleviate that?
One of the biggest things is I think federally there needs to be better policy that allow and incentivize builders and developers to pull out more cash. So for example, in Canada, if you create a certain amount of affordable housing units within your building, you can finance up to 95%, whereas here, not even close. And so a lot of builders are leaving 40% of their cash in a building, and that prevents them from building forward. Also on the building side, if you're using, say you're building a building for easy figures, $20 million building, if you do that as an affordable building using public funds for some of that construction, there's all this regulation that all of a sudden the cost is about 40% more just to do the exact same building. So I think we're getting tied up in the minutia, and we're not stepping back and looking at the fact that we haven't seen rapid enough growth to solve the problem when it comes to actually supplying inventory.
And it's also adding density. Again, there are different areas that are doing great things, but when you can add some more density, even in California, so for example, my house, I'm allowed to have 2 suites. I can have 2 ADUs, which is great because I could rent both those out and it's helping with the crisis. However, the backlog to get to that point, one of my ADUs, it should have been approved in a week. I waited 5 months, and there's such a backlog, and the process is so archaic. We need to revitalize the process to get people moving to add density.
This is one of the things where I'm hoping that AI is actually helpful, because the bureaucracy behind trying to wait through the planning process, anyone who's taken on a renovation knows how annoying it is to wait on your permits, wait for the city, also wait for the utilities to go through and process everything. I would love to see something that automates a lot of that to make sure that the I's are getting dotted and the T's are getting crossed, but you can actually get in and do the work.
And as I say, this literally is right now in modern history. This is the absolute worst affordable housing market in history for first-time home buyers. Look at first-time home buyers are less than 25% of the market right now, and that should be a lot higher. It's just not feasible for people to get into real estate like it used to be.
Obviously, you've had a presence specifically on HGTV now for more than a decade. You've had a lot of iterations of your show, and obviously shows that don't actually feature you two. How much has that changed in terms of being able to produce a show like that at a reasonable cost? Have whatever relationship you have with HGTV and actually make it profitable for everyone.
I mean, so we are one of the largest unscripted producers in North America. We have 15 series that we produce. We host 2 of them, but we have found a huge shift because what we used to have for budgets for our shows down here on HGTV or with other partners, we don't have that anymore. So we as producers have to get more creative. And sometimes that means going to Canada, greenlighting with a co-pro out of Canada, and then coming down with a license. Or co-proing with the U.S. down here. So we're really good at getting creative, but plus our company stands out from other production companies because we are up in Toronto for our production base, so we can actually take advantage of a lot of tax incentives up in Canada that are great that a lot of U.S. producers can't.
Well, and we're also seeing explosive growth in digital and other forms of media, YouTube, everything else. So we've always stayed a step ahead. We're always looking at where the industry is going. Right now, television, traditional television, I mean, what's the word? Imploding. Everyone's uncertain. There's a lot of mergers happening, and so things are paused. But that's what I like, is the fact that we're constantly looking ahead. So there's enough opportunity that we can still find placement.
As has some of the mergers, particularly Warner Brothers being absorbed into Paramount. Has that affected at all maybe your outlook for what HGTV and Discovery ends up being?
Yeah, absolutely. It's more of a pause. That's what it is right now, because nobody wants to jump in a direction if they don't know who's going to own the company or what the focus is going to be. But if you look at Netflix, they were only interested in studio side streaming. They weren't interested in linear cable. So Paramount's taking everything. So that does mean that we're the largest producer for HGTV for Warner Brothers on the unscripted. Now we'll have that opportunity to do the same with Paramount.
Jonathan and Drew Scott there, the Property Brothers, on the launch of their new program, but more importantly, an interesting conversation there about housing affordability, particularly in the markets that they're focused on, primarily out west and in Canada. And that's where we want to keep the conversation going. But in New York City, the new mayor here, Zohran Mamdani, has proposed freezing rents. He's proposed raising property taxes. He's proposed right of first refusals on the sale of some multifamily properties, all in an attempt to make good on his commitment to New Yorkers to lower the cost of living. Joining us right now is Massimo D'Angelo. He's the co-chair of the law firm Blank Rome's real estate industry team, and he joins us here in Studio 2. Massimo, great to have you here.
Great, thank you for having me.
Let's talk about some of these proposals. I want to start first off with the rent freeze, because this seems to be the one that a lot of people are focused on. It also seems to be one of his proposals that actually seems like it might actually see the light of day.
Yeah, it will. On the rent freeze in particular, in the 11th hour when Mayor Adams was leaving office, he tried to put in a blockade, put certain people on that would deflect against a rent freeze. In the last few weeks, many of those people have resigned. So we have a total of 9. We have 2 tenant members, 2 owner members, and then 5 general, including a chairperson. And so he now has the votes, the requisite votes. So come June, the rent guideline boards is likely to enact a rent freeze.
If you talk to landlords, it seems like they're all gloom and doom with this. They say, look, building costs aren't static. They continue to go up. So if you can't actually raise the rents in a meaningful way, then there becomes an imbalance. Is there any sort of potential for that to be rectified, or is this just something that would have to live with in the short term? And what would be the consequences of that?
And the consequences will be dire. I mean, all those things collectively put together. And really, you go back to June of 2019 with the Housing Stability and Tenant Protection Act. And if you saw what happened directly after that passed, within days of the passage of the HSTPA, Blackstone pulled 11,000 contracts to redevelop affordable housing, rent-regulated units in Peter Cooper Village and Stuytown. And so now, with the increase of real estate taxes as well, there is little incentive for owners to rehabilitate units. And so all those things taken together, creates further stresses upon affordability.
Well, I mean, Mamdani, of course, he would argue that, look, he has proposals on the table to maybe rely a little bit more on nonprofit organizations to help with that redevelopment. And I know one of the other proposals was this idea that if you were selling a multifamily property, the idea that some of these nonprofit groups, I think you can explain more how it works, they would get right of first refusal over who?
That's correct.
Yeah.
So it's one of the things that he actually campaigned on quite heavily, which is this COPA legislation. It's a right of first refusal. As you said, if it's a building with 4 or more units, you first had to go to HPD, and it was a city-administered program, and you had to, give the right to buy first to a not-for-profit tenant organization, charitable organization. And so I actually wrote an article on this in the New York Law Journal. And within days of my article, and I called into question, the constitutional issues with this legislation. And within days, there were reports from the Mamdani Law Department also raising similar concerns and constitutional red flags. And a few days later, it was completely nixed. And this, I think, jives, too, with the rapport now between federal and city. Like we had in the 1940s with Robert Moses, who is the greatest developer in American history, essentially, and the most powerful civil servant that we've ever seen. And he really built what we know as New York today, with the tripartite struggle between, and the schisms between FDR and Fiorello LaGuardia, who was the mayor in the day, back in the 40s. And you're seeing some of that now. And it's always important to look at the historical comparisons of those political schisms and how they work out politically. Right. In the 40s, it worked out because it was the New Deal. Right. And so it was easy. There were, tailwinds, and essentially the affordable housing got constructed. In today's world, it's very interesting because there's been 2 meetings now to date between Trump and Mamdani, where Mamdani has gone down to Washington, D.C. to meet with Trump. And the latest proposal now is the biggest affordable housing development in the last 50 years. The first one was in Co-op City in the Bronx with 15,000 units, which was also a Robert Moses development. Right. And now we have this proposed Sunnyside Yards, which is going to create 12,000 units, 30,000 union jobs, and basically a mini city. But we're talking about a $21 billion project. And we're talking about Amtrak owning parts of it, the MTA owning parts of it.
So what's the issue with that, though? I mean, at the end of the day, I mean, they're trying to address an affordability issue. Does this not address it?
It certainly addresses it if the politics can align. Right? So if you look back, again, that's why I think it's important to look at the historical perspectives. You look back then, the affordable construction was done. We had Co-op City, and it led to a tremendous amount of affordable housing, which the city has needed for over a century now. And Trump has said it when they had the meeting. We both agree, meaning Trump and Mamdani both are of the same mindset. We need affordable housing. It's not only a New York City issue, it's a global crisis. But Trump has said we need to agree on how to get there. And if a rent freeze goes in place, if there are increases in real property taxes, the political ideologies may not align completely to get it done.
All right. We got to leave it there. Massimo, great to have you here. Massimo D'Angelo, co-chair over at Blank Rome's real estate industry team. Now, we do want to check in right now. There's a conference going on here in New York City with Howard Marks, of course, the co-founder of Oak Tree Capital Management, now in conversation with Lisa Abramowitz. Let's take a listen as to what they have to say.
We've never contemplated questions like these.
Which is the reason why I think people are concerned about the concentration of certain types of investments by private fund managers, that the lack of transparency is making people uneasy. A sense of they're not sure how those loans were made. Is there anything in the way in terms of the leverage or the covenants that were used that makes you think maybe we're getting to the end of a cycle, or that feels a bit frothy, and that people are right to say maybe there needs to be a washout?
I've spent the last 3 days writing a memo, that may not surprise you, about private credit. These days, I speak a lot at occasions like these and to our clients and CFA groups and so forth. And everybody has questions, but at any given point in time, the questions are usually the same for obvious reasons. And, in the last few months, or certainly the last 6 weeks, the main question has been, what about private credit? Well, a year ago, I wrote a memo called Give Me Credit, and I said in there the only question I was getting was, what about private credit, but in a good sense. What about private credit? Do we have enough? Should we put in more? Is it the key to riches without risk? And today they're asking, what about private credit, but in a different vein. I've been around long enough to have seen many cycles of boom bust, not economic boom bust of an idea. And, something new comes along. It's invariably something new because the new thing fires the imagination and is easily sold to people. And because it's new, there's never been a chance to see its flaws in action. So these things, I don't think there's ever been a bubble in something prosaic. There was never a steel bubble, or a hamburger bubble. But it's new technologies or new financial innovations. And so people buy in, on the basis of promise without an understanding of the downside. And then something happens which causes their
Oaktree co-founder Howard Marks speaking right now with our Lisa Abramowitz at a conference here in New York City about the state of private capital and specifically as it relates to the software and AI concerns in there. Meanwhile, we turn back to the public markets and look at some of the after-hours movers. Lululemon shares have been under pressure since it reported results. It did have a surprise jump in total comp sales in the most recent quarter, up about 2% when the street was looking for a drop of about 2%. However, the forecast going forward a little bit light and no clarity as to when we'll get a permanent CEO to lead this company forward. DocuSign moving higher after beating on several of its key metrics and providing a full-year revenue forecast that seemed to please investors. And Oklo been kind of oscillating between gains and losses here. Still a loss-making company. EPS loss, I should say, of 72 cents a share in the most recent quarter. That was actually about 2 cents better than what it was in the previous year. All right, we want to pivot from that and pivot to basketball. March Madness, of course, that is the college basketball tournament set to tip off in just a couple of days. The first 4 play-in games are going to gear up for tonight and tomorrow. And Americans are set to legally wager more than $3 billion over the course of both the men's and women's tournaments. That would be a 54% increase over the past 3 years. That's according to the American Gaming Association. But of course, there's some new kids in town here. It's the prediction markets. And joining us to discuss their role in all this is JB Mackenzie, Vice President and General Manager of Futures and International over at Robinhood. All right, JB, great to have you here on the program. I do want to talk about the kind of I guess we could still call it somewhat nascent prediction markets, particularly in the sports world. Obviously, Robinhood has jumped on that. I am curious as to how you sort of fit in to a big gambling event like this where people are, they're wagering on spreads and they're wagering on, very specific things that go on. And obviously, what you're doing with your prediction market is much more binary.
Yeah, first of all, thanks a lot for having me on. It's always a pleasure to be back. Hard to believe that it was almost a year ago I was here just announcing that we were entering into this March Madness bracket, and how fast the world changes and turns that we're back here again. So, when we look at the sports market business overall, it is an opportunity for us to be able to take the rigor of financial markets and bring them into the sports world. And what we have found more than anything else is that clients and customers are incredibly engaged. We've had over 12 billion event contracts traded in 25. But just in the first 2 months of this year, over 6 billion has been traded again. And what we find is that tells us that what we're building is meeting customer demands, and what they're coming to us and asking us is to do more. Yeah. And so we're excited about what this next event contract market's going to look like for the March Madness. We've actually enhanced our offering quite a bit, where we have been able to bring forward the ability to trade between multiple games. both on the men's and women, as well as being able to offer different outcomes than just who will win the tournament or who will win a specific game. And then finally, for those people that don't want to trade sports, we've actually created a sports opt-out capability. So you actually can remove it from the actual platform as well. So again, what we're doing is listening to our customers and building what they want, and then hopefully see the reactions that we've been seeing.
All right, well, let's stay on the opt-in here, because that is the focus of this week for pretty much everybody. And I am just curious about, I mean, do you have any metrics you can share, like in terms of what types of contract, the volume of contracts that you had last year, and maybe what you're expecting this year? I'm talking specifically for March Madness.
Yeah, I mean, last year we did almost 400 million contracts just on March Madness alone. And while I can't really give a prediction per se of what we'll see, what I can tell you in the last week alone with all of the various conference championships that occurred, we saw almost the identical volume traded in that week as we did last year. So our expectation is with the enhancement of the product and clients' interest that we will continue to see participation continue to increase. We've seen it just along the way where we had the most unique users trading in the month of February that we have seen since we actually launched our election contracts back during the presidential election. So I think overall what we're seeing is clients are interested and intrigued with the product, and we just try to keep meeting their demand, and we think we've been doing it. So this should be a great March Madness from our perspective, both for the men and the women.
With regards to the people who are using the Robinhood platform specifically for March Madness, or for that matter, other sporting events, are these customers that effectively you're kind of stealing from some of the more traditional gaming sites, or are these kind of just people that maybe would not have actually wagered at all, and they're kind of basically new entrants, if you will?
I think it's actually a combination. And I think what we're seeing is that for those that have been in the traditional markets, they're looking at the efficiency that we're bringing into the marketplace for them, and they're moving over potentially to do that. But I think more importantly, what we're also able to do is to show people within our existing ecosystem of over 27 million accounts that they have the ability to access these prediction markets. And if sports is something they want to do, they have access to it. But we also see tremendous growth in other areas outside of sport, especially associated with volatility products in crypto, in gold, silver, as well as in crude oil. So I think it provides a lot of different opportunities, which then allows our customers to access these in one place. And that's what our goal is at Robinhood, is to be that super app where people can access what markets they want to at any time.
All right, JB, got to leave it there. JB Mackenzie, Vice President and General Manager of Futures and International over at Robinhood. A closer look here at their burgeoning prediction market business ahead of March Madness tipping off in just a couple of days. Meanwhile, we're going to set you up for what to watch over the next 24 hours back in financial markets. A busy day ahead tomorrow. That's coming up next, right here on The Close on Bloomberg. A somewhat subdued day here on Wall Street on this Tuesday afternoon. Things are going to pick up over the next 24 hours. We get earnings in the morning from the consumer space, from department store Macy's, and of course cereal maker General Mills. After market, more earnings, this time from memory darling Micron, as well as Five Below. And there is a slew of economic data to keep an eye on. The producer price index will be released at 8:30 a.m. tomorrow morning. We're also going to read on factory orders and durable goods. And of course, that becomes the backdrop for 2 p.m. The Fed decides. The Jay Powell set to deliver his press conference at 2:30 p.m. Eastern Time. Full coverage starts here on Bloomberg at 1:30 p.m. Of course, with team surveillance leading the charge. A lot of questions right now about how the Fed will debate the potential inflationary impacts of the war in Iran. And also keep an eye on Disney. They have their annual shareholder meeting tomorrow, and it will be a passing of the torch again from Bob Iger, but this time to Josh D'Amaro, who officially becomes the CEO of the Walt Disney Company. For all your political coverage, stick around. It's up next.